Inflation is the rate at which the general level of prices for goods and services is rising, leading to a decrease in the purchasing power of a currency. In other words, as inflation increases, each unit of currency buys fewer goods and services. Key points about inflation. Measurement. Inflation is typically measured as a percentage increase in the Consumer Price Index, CPI, or the Producer Price Index, PPI. These indices track the average change over time in the prices paid by consumers and producers for a basket of goods and services. Causes of inflation. Inflation can be caused by various factors, including demand pull inflation. Occurs when aggregate demand for goods and services exceeds aggregate supply, leading to an increase in prices. Cost push inflation. Results from an increase in the cost of production, such as rising wages or higher raw material prices, leading producers to pass on these costs to consumers. Effects on purchasing power. Inflation erodes the purchasing power of money. As prices rise, a given amount of money buys fewer goods and services. This reduction in purchasing power can affect consumers' standards of living and their ability to afford necessities. Interest rates. Central banks often use interest rates as a tool to control inflation. By adjusting interest rates, central banks aim to influence spending and investment. Higher interest rates can help cool an overheated economy and reduce inflation, while lower interest rates can stimulate economic activity during periods of low inflation or deflation. Impact on savers and borrowers. Inflation can have contrasting effects on savers and borrowers. Savers may see the real value of their savings decline if interest rates do not keep pace with inflation. On the other hand, borrowers may benefit from inflation if the interest rate on their loans is lower than the inflation rate, effectively reducing the real burden of debt. Uncertainty and planning. Higher unpredictable inflation can create uncertainty for businesses and individuals. Businesses may find it challenging to plan for the future, set prices, and make long-term investments. Individuals may face uncertainties about the future value of their money and may be less inclined to save. Fixed incomes. People on fixed incomes, such as retirees receiving pensions, may experience a reduction in their real income if inflation outpaces any cost of living adjustments. This can impact the standard of living for those on fixed incomes. International trade. Inflation can affect a country's competitiveness in international trade. If a country experiences higher inflation than its trading partners, its goods and services may become relatively more expensive, potentially leading to a decline in exports. Hyperinflation. In extreme cases, hyperinflation can occur, characterized by extremely high and typically accelerating inflation rates. Hyperinflation can have severe economic and social consequences, leading to the breakdown of normal economic activities and undermining confidence in the currency. Deflation concerns. While inflation is a concern, deflation, negative inflation, can also pose risks to an economy. Deflation can lead to a decrease in consumer spending as people delay purchases in the hope of lower prices in the future, potentially causing a downward economic spiral. In summary, inflation is a complex economic phenomenon with various causes and effects. Central banks and policymakers closely monitor inflation and use monetary policy tools to manage its impact on the economy, aiming for price stability and sustainable economic growth.